Welcome to Cheques and Balances. I'm Vincent. This is James Blair. And this week, the beginner's guide to insurance.
The beginner's guide to insurance, Mike. When I think about insurance and when I'm talking to people about insurance, they go, James, I've got 10 things to do on my list. 1 to 9 is interesting stuff. Number 10, maybe number 11 as well. Life insurance, income protection, and then maybe the will as well.
Well, it's down so far because no one wants to think about it. 1, you're right, it is boring. And 2, you're going to remind me that I'm going to die someday. Not exactly the most fun conversation.
It's a big room, isn't it?
It is.
So when we're thinking about insurance in that respect and the to-do list, you do 1 to 9, you do the fun stuff, number 10's there, and then you fill it back up with more interesting stuff again so it stays 10 and 11.
Exactly. And there are a number of different types of insurances. There's house, contents, medical, all this sort of stuff. But just for today, we're going to be focusing on your personal insurances, so life, income, maybe crisis cover, these sorts of things.
Great, okay. And we thought because insurance can be a bit of a dry subject, we're talking about our own mortality, people getting sick. I think in New Zealand, we don't, like, to give you an idea, 97% of Kiwis have car insurance.
Yeah.
So if you think about car insurance, right? If you hit another car, it's going to have a financial impact. It's probably not going to be that good for you, but you're most likely going to recover, especially if it's your own car that gets damaged. If you get sick and can't work for a period of time, or if you are in a couple with a joint mortgage and you pass away, it's highly likely you'll never recover from that financial impact. Let alone the the impact on you emotionally and having to mourn that situation.
I'm never going to financially recover from this.
No.
Yeah. No, cool. So I think what we'll sort of do is I'll approach it from a customer's perspective. I get to release my inner Karen. I get to give James a hard time. Why are you ripping me off with all this Fugazi insurance? And we'll see if he can see if he's up to the task to respond.
Yeah, we thought we'd try and make it as interesting as we can. We're going to get cancelled for the Karen reference, Mike.
Probably, yeah.
Please don't let that trend.
No, that's all good.
So where do you want to start, Mike?
All right, let's start with the big one. Hey, I'm a fit and healthy guy. Why do I need insurance?
Yeah, I mean, it's a good question. I think the starting point, and alluding to, talking about cars and your income and your health, is what is your biggest asset? A lot of what we talk about here is around financial planning for your future, is what is going to allow us to achieve those goals.
Yeah.
Likely your biggest asset isn't going to be, that slick 1996 Honda Civic you're driving around. Another reference.
Another one.
It's not going to be your house most likely. You might go, I've got a lot of value in my house. It's not going to be your house.
Yep.
It's going to be your health, your ability to earn, and your income in the future. So if you think about it, your income is your biggest asset.
Yep.
So that's why it's important to insure and make sure you're taking care of it. Now there's a couple of different ways to be thinking about it. One is as a single and the other is as a family. So if you're a single and so say for example you're just riding solo, maybe you've got a house, maybe you're just renting, whatever, you might go, I don't need insurance. I can guarantee you, unless you have mum and dad to fall back on you, if you got sick, seriously ill and couldn't work, and you can pay your rent or your mortgage or your bills or contribute towards your investments to achieve your long-term goals, it's going to financially really, really impact you.
Yeah. But, let's put myself in that scenario. James, doesn't ACC cover all this? What are you talking about?
ACC is a really good tool. Firstly, it stops all of us suing each other like in the States.
Yeah.
ACC only covers accidents though.
Okay.
So ACC is about if you were to have a skiing accident that you broke your back and you weren't able to work for 6 months, ACC would pay you 80% of your cover.
Yeah.
But if you had cancer or if you got sick, you wouldn't get paid anything from ACC. It's purely to do with accident.
Okay.
So that's the benefit of ACC. But when it comes to illness or as well with death, you need to make sure you've got cover in place. So that's why it might be important as a single. But then when it comes to a family as well, it becomes even more complicated, right?
Yeah.
You've got other people that you're dependent on. Maybe you're potentially a single household income, or you've combined your incomes to buy a bigger home. It's important that if you pass away, that there's enough money left aside that your family's going to be okay. They don't have to mourn you and sell their house.
Yeah.
And if you get sick, just like an individual, that you can continue contributing towards the household as well.
Okay, that makes a little bit of sense.
Not convinced yet though.
So there's a gap with the ACC when that's getting sick, terminal illness or critical or something like that. So let's say I've drunk the Kool-Aid, I've got some insurance. James, my insurance broker tells me it's going to be $1,000 a month. Is that reasonable? How do I know I'm not getting ripped off?
Yeah, and I don't want to go on too much of a rant here, but the insurance industry, kind of like lots of different industries, there's good people and there's bad people. I know some cracking insurance advisors that I'd be comfortable referring, Michael, my dear friend too, and there's some other ones who I go, my goodness, how do you have a job?
Yeah.
And unfortunately, I do run into those ones sometimes. Sometimes you'll talk to an insurance. The thing about insurance is how do insurance people get paid?
Yeah.
And they get paid based off a multiple of what they sell you. So essentially, the more insurance they sell you, the more money they get paid. So straight away, you've got a conflict there, right?
Yeah.
So when you're talking to an insurance advisor, sometimes they will go, here's like a platinum plated product that covers all the bells and whistles. If you sneeze, you'll get paid out money. A whole range of kind of things. I've seen scenarios where they've insured all their investment property debt, and that's one that's really bad because you've still got renters paying the mortgage, and it's not necessarily required. So insuring your to answer your question, Mike, for those that go insurance is really expensive, it can be. There's different levers you can pull though to make it cheaper.
Yep.
So for example, with your let's start with life insurance.
Okay.
So say you and Christina, right, your fiance, you both work.
Yeah.
If one of you were to pass away, you don't necessarily need to cover your whole mortgage at this point in your life because the other person has a good salary and they're already covering half the mortgage.
Yeah.
So instead of covering the full mortgage, you might cover half of the mortgage, and then so that's your half gone, and then Christina will be okay with the other half.
Well, I mean, I guess if we covered the whole thing, she'd be looking at me like he's pretty annoying.
Yeah.
And I could do really well out of this.
Well, I mean, I insured you that way for your own safety, really. So that's a way to think about it from a life insurance perspective, that maybe you're in a position to insure half if you're both earning similar amounts opposed to insuring all of it. Any other type of debt, investment property debt, make sure it's really thought out why you need that cover.
Yeah.
Income protection, Michael, is the most expensive type of insurance.
Yeah.
Do you know why it's the most expensive type of insurance?
Is it because they pay out the most on it, or it has something to do with the risk?
Yeah, you're more likely to get sick than you are to pass away.
I played that up like I I knew what I was talking about. That was a complete guess.
Hey, you did a good job. Thanks. And if you didn't say that, people would have never known. There's a saying about that. Open your mouth. So income protection, you're more likely to claim on it than if you were to pass away. Obviously, more likely to get sick than to die. There's different levers you can pull around income protection. So, for example, the first one is what percentage of your income you insure, right?
Yeah.
If you've got a really big salary, it's going to be expensive. Maybe you could insure 50% of it, or something along those lines.
Yeah.
The other two options, which we're going to give some examples, which will be really helpful, is the first one is how long do you have to be sick for before you get paid out?
Yeah.
So typically you'll have to wait 4, 8, or 13 weeks. To give you an idea, 4 weeks is twice as expensive as 13 weeks.
Okay.
So if you've got a decent emergency fund, you could probably wait 3 months. The other one is how long you get paid for. So are you going to get an income protection policy where you get paid till age 65?
Yeah.
Now, there's a 96% chance you get better within 5 years. There's a 94% chance you get better within 2 years.
Yeah.
Statman's in full form today, Mike.
There he is.
Yeah, done a little bit of insurance in my time. So the income protection, if you're thinking about it, say Michael is 30, insuring him for 35 years, it's going to cost you some money.
Yeah.
Insuring you for 5 or 2 years, completely different.
Yeah.
So they're the levers you can pull to make it more expensive. So yes, and as the examples we'll give, is it can be more expensive, but on the flip side, if you know what you're doing, if you ask the right questions, you can work it all right.
Yeah, and that's a really common sort of objection that we hear when we're talking to people about insurances and covering these sorts of things. And as a mortgage broker, we have to discuss this sort of risk with our customers, because when you're taking on a large amount of debt, it is the fiscally responsible, the prudential thing to do. But I guess, the flip side to sort of think about there, and sort of a really poignant point that we sort of discuss with our customers is, what happens if you can't pay the mortgage back? you know, and it's really easy to say, oh, maybe this, or sell a house, do this. But if you actually put yourself in that situation, and we unfortunately have seen this situation a number of times, is let's say someone's passed away, you are mourning the loss of a loved one, the income is gone, there's no insurance, and halfway through this, the bank's calling you on the phone saying, you need to sell the house.
Yep.
Yeah, not a really good position to be in. And to be honest, from the bank's perspective, they don't want to do that either. Yeah, it's just not a nice phone call to have. So yeah, it's the expense thing, absolutely understand it. It can seem expensive, but like James said, there are levers you can pull to make it a little bit cheaper and still make sure you have some protection in place. So, you know, you are covered to a degree.
Yeah, and I'll just call a spade. It's irresponsible. So if you're single and you go, I don't want income protection, the only person you're really screwing over is yourself.
Yeah.
If you've got kids or you've got someone who is dependent on you, say you're making the income and the other person's investing time into the family, and you're going, insurance is a waste of money, I'm not going to pay that. Everybody thinks they're bulletproof until they're not bulletproof.
Yeah.
And the reason I'm so passionate about this subject is people come to me and they go, my husband, my wife, my spouse has passed away or is sick. Fix it?
Yeah.
And it's pretty much impossible to fix in hindsight.
Yeah, a really good point there actually. So just before we jump into some of the examples, what I wanted to talk about quickly was, because you know, I see this quite often with people who have financial products that just don't fit their needs, or their needs have changed over time and that sort of thing. So how often should you be reviewing this? You know, should you use a mortgage broker? Should you just go straight to the company? You know, what does that sort of look like?
Yeah,
an insurance broker.
Yeah, as I said before, I do insurance here at Lighthouse, but there are tons of good insurance brokers out there. I think the main one is going, you know, most people have a pretty good gut. Is this person trying to use jargon and confusing me?
Yeah.
Are they actually understanding my situation and giving me different options? Do I feel like I'm getting pushed into something? Find somebody you trust, whether that's a financial advisor. Like a lot of people like dealing with people like myself in more holistic roles, because I'm trying to help grow their wealth as well, opposed to just insuring their risks.
Yeah.
But as I said, lots of really good insurance advisors out there as well. To answer your question though, Mike, around the how often should you review it, annually is what you should do. You know, you're living your life, you're busy, but your situation will change over time. The amount of times I talk to people and they go, well, we got this out when our kids were 2 and now they're 30 and we haven't reviewed our insurance. It does happen quite a bit. Insurance gets more expensive, but as you pay down your mortgage, you have your other investments, you do the other things we talk about on this podcast, you can create some financial freedom. Yeah. And I get a huge buzz, Mike, when I'm able to reduce people's insurances because it shows a sign of success, right? Yeah. And you're slowly self-insuring over time.
Oh, cool. Okay, so what we'll do now is we'll jump into a couple of examples. So, you know, the first one, I'm not even going to pretend like I'm not looking at a screen here. So, couple in their early 30s, one earns 100K and the other one is a stay-at-home dad who's looking after 200 kids. And let's say they've got an 800K mortgage.
That's a lot of kids, Mike. So, yeah, we just thought we'd give a couple of examples so you get a bit of an idea of how much things might cost. Yep. We definitely, if we can get a big disclaimer flashing under this, depends on your situation, make sure you talk to somebody so you find the right levels of cover for you. Yep. But to give you an idea, if you're in that scenario Mike broke down where you've got a large mortgage, you've got one person earning the income, the person earning the income with a 800K mortgage, they might want like $1 million of life insurance as a number. Yep. This will depend on their risk profile, how comfortable they are taking risks. But the logic behind $1 million at a high level is you can clear the mortgage, you got a couple of years of income as well, so you can make changes to your situation. The other option would be you might pay off half the mortgage and use the other half to invest and pay you a regular income. Yep. So you might have a life insurance amount of $1 million. You might have like $50,000 as a lump sum if you get sick. So that will pay you regularly, and that will pay you a lump sum, and will also tide you over for any one-off costs and tide you over until your income protection gets paid out. Yep. And then also ensuring your income for that person is really important. Okay. For the stay-at-home dad, it might be something more like $400,000 of life insurance. Yep. Even though they're not contributing financially to the household, you've got young kids, you've got to work out, like if you've got family around who really wants to help, that might change it. But you've got to make sure that there's a way to think about that contribution to the household and the kids.
Yep.
And then it might be something like $150,000 as a lump sum if you get sick.
Okay.
That covers a couple of years of income. You might go, well, where does that number come from? Once again, 94% chance you get better within 2 years. The other person who's earning the income is going to want to take some time off work because their spouse might have cancer or had a stroke or a heart attack. Not going to really feel like wanting to do their 9 to 5, right?
No, exactly. And what's the cost on that?
So we just did like a quick quote, and it was looking around $120 a fortnight.
Yep.
So that's what, maybe like $3,000 a year?
Yep.
$2,800, something like that. Now to give you an example around the levers you can pull to make insurance cheaper, this is with you getting paid your income protection until age 65 with a 4-week stand down period. So let's say instead you had a 13-week waiting period, so you're going to be off sick for 3 months. Maybe you've got an emergency fund, some cash you can pull back on, and you get paid for 2 years instead of until age 65.
Yep.
That cuts the cost in half. So if we're talking about making it affordable, don't tell me that there's not a way to make this work. You go from 120 a fortnight to 60 a fortnight. Pretty good bang for buck.
Yeah, absolutely. Okay, and then so last example before we wrap up, single female earning 100K, 500K mortgage.
Yep. So if we think about this scenario, like from a life insurance perspective, you're not, if you pass away, and for all those single people out there, please take this in the way it's intended. There's nobody dependent on you, right? So there's going to be a lot of people who are sad, but there's nobody who's going to be financially impacted. So you probably don't need a lot of life insurance. You might have a really small amount, maybe like 20, 50,000 to cover funeral costs, estate costs. The main thing you're wanting to insure is your income.
Yep.
So you're wanting to insure your income, and so just to insure your income is probably going to be about $85 a fortnight for a single person. If you're insuring a $100,000 income, 4-week waiting period and paid till 65.
Yep.
This one, when I did the second quote, even surprised me, Mike. If you reduced it to a 2-year payment period and you waited 3 months to get paid your income protection, dropped to $27 a fortnight.
Yeah, pretty good.
I mean, it's pretty much as exciting as insurance gets.
It is.
I'll actually tell you the other exciting part of insurance, since you've made it this far into the podcast. When you fill out insurance application forms, under health insurance, they ask if your children smoke. And I always have a good chuckle at that one. Hopefully there's no smoking children out there.
Yeah, fair enough. No, cool. Okay, so I think what we'll do is we'll wrap it up there. Thanks for getting this far through the insurance podcast. I really feel like I've carried the team here. My acting skills have really done the business.
Yeah. So once again, insurance is one of those things. If we break it down into 3 parts of a financial plan, you're coming up with a strategy to grow your wealth. There's the actual growing itself with the shares and the property and the paying down your debt. Protecting your wealth is so important. It's not a sunk cost. It's just part of good financial planning. You hope it's a waste of money. If it's money well spent, that hasn't worked out too well for you. So make sure you're having those conversations. Make sure you're talking to your spouse if you have one around what they would want in that situation as well. We'll wrap it up there. Thank you very much for joining us this week. And just before we go, make sure to check out Money Bites on YouTube. We're just about to drop another bunch of episodes explaining simple money concepts. I think this time I'm talking about what's a bear market, what's a bull market, volatility, ACC. What are you talking about, Mike?
I've got a bit in there. Things like due diligence, how to value a property, and then I've got the shortest money bite that will ever be bit. What is a basis point?
Yeah, you actually explained it. What's a bit?
Pretty much, yeah.
Okay, thank you very much for joining us. We'll see you next week.